discuss is Burns McKinney. He's managing director and senior portfolio manager at NFJ Investment Group. So Burns, thanks for being here. Let's start with the Israel-Iran conflict. Even with those reports of a possible de-escalation, do you think geopolitical risks are fully priced into this stock market? And if not, what could that mean for volatility moving forward?
The markets have really been behaving as though that there really isn't a long-term risk being presented. I think one of the things that the markets have kind of learned really ever since the initial Russian invasion of Ukraine is that every time we've had some sort of geopolitical conflict in the Middle East, and oil prices have spiked initially, but they've tended to pull back every single time, and it appears that investors have learned their lessons from that. Likewise, if you look at take a look at keys or hints from other areas of the market, despite the conflict between Israel and Iran over the weekend, you didn't see an investor flight to haven assets. You didn't see big investor demand for the dollar or for 10-year treasuries, and so the markets have been pretty complacent on this in the near term.
Yeah, that was an interesting thing to watch, that there wasn't this flight to safety. But there is a growing argument that an oil shock could potentially dent demand, possibly weaken the labor market, and ultimately force the Fed's hand. How do you view the current conflict's potential to accelerate the pace or even the number of rate cuts that we see this year?
That's a great point. I think one of the most important plays that this could at least affect U.S. investors would be, what does it mean for the coming Fed meeting? It appears that the meeting that the Fed has this week, they probably weren't lining up to cut rates anyway. But a lot of what the Fed's been doing is they've been patient. They've taken a wait and see, a data-dependent mode, just simply because of the fact that tariffs tend to be historically, or at least on paper, tend to be inflationary. It appears that the tariffs thus far really haven't had that type of inflationary effect. But then over the weekend, you have sort of the monkey wrench thrown in. Okay, we've been focused on what the tariffs will be doing for inflation, but now we have the potential for an energy price spike to also at least give the Fed something to think about, which all of which suggests that the Fed probably isn't in line to actually make any moves until sometime this fall. We do believe they remain ultimately in rate cutting mode, but where investors really should be focused this Wednesday is not necessarily what they do Wednesday, but what happens with the so-called the dot plot, the Fed projections. As of right now, I think, or at least as of the last meeting, that dot plot suggested 2 quarter-point cuts later this year. I think a lot of the forecasters are suggesting that having a lot to do with what's going on between Israel and Iran, that might actually become, one potential cut this year, which might cause the long end of the curve to pop up a little bit.
And as you were just alluding to, tariffs remain a big TBD factor for the Fed. We did see that Trump's pivot from those Liberation Day announcements that's fueled a lot of the market gains that we've seen. So realistically, though, you say that optimism has been priced into this market. Can we get higher? And if so, what are the catalysts that we need to see?
A lot of those catalysts have already taken place. As you saw, the market dipped back in April with what was really the quote, the Liberation Day announcement was what really one of the greatest self-inflicted policy wounds that we've seen in many years. And as investors have seen that, okay, well, you have a pain trade. The president has historically had a tendency to retreat when the market is kind of thrown up a little bit at bad policy announcements. And so a lot of what the markets are pricing in now, the S&P is basically back to where it was pre April 2nd, despite the fact that where we're ultimately likely to settle out is still with tariffs 4 times what we've seen in any of our lifetimes. And so a lot of coming deals and good news have already been priced in to the markets. And where we stand right now, we got the S&P trading at 21, 22 times earnings. It's more expensive than it's been 3/4 of the time this century. And so investors are probably going to have to rely on either just good old-fashioned earnings growth, which should be more muted for the rest of this year, or just getting returns from companies that are paying and growing dividends. So we're not expecting to see a 40-yard bomb down the field. It might just be 2 or 3 yards in a cloud of dust.
Burns, would you say this has been one of the most hated stock market rallies out there, considering where we're at with sentiment, yet we still have equities hovering near those record highs?
That's a great way of putting it. The investment community has basically been dragged, by the heels along with this market rally. There really hasn't been a boom in enthusiasm. Last year, when the markets were rallying, investors really climbed a wall of worry. You had a recession that was bound to happen. Well, it didn't. You had an uncertain election. Well, we got a fairly certain outcome. You had geopolitical conflict. Well, none of that has necessarily escalated to elsewhere. And now we're really in a place where the policy news is kind of shifted. And if anything, we have maybe a wall of complacency in that we have a world in which the policy, certainly we have the tariff talk, but now investors are, maybe pivoting towards focusing on tax cuts, on deregulation. We do still have a Fed that is in rate cutting mode. And so a lot of the bad news has been priced in. And, we're probably in a place where a lot of the good news is as well. So that, investors really should just have to rely on the underlying fundamentals of earnings growth, which should be a bit more muted this year.
All right, Burns, thanks so much. Appreciate those insights.
Thank you.